Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks and futures drop, and oil jumps as fears of a prolonged conflict in the Middle East take hold. Global bonds advance with investors worried that higher crude prices will weigh on economic growth. President Trump says Iran has given into most of the U.S.'s demands from its 15-point plan, but it remains unclear whether each side is actually even negotiating. The Yemen-based Houthis joined the war, striking Israel and saying they'll continue fighting until attacks on Iran and its proxy militant group cease. That's as thousands more U.S. troops arrive in the region. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. We've changed the clock, so we are now an 8 a.m. show for those of us who are tuning in. Happy Monday to everybody. It is day 31 of this war, and yet again, I sound like a broken clock. No signs really of things de-intensifying, despite the diplomatic push that Pakistan has been making over the course of the weekend. And so we walk in this morning. The mood is once again risk-off. You can see the handover from Asia pretty negative. The MSCI Asia Pacific down 1.9%. U.S. futures also pointing towards the red as well, down about 0.5%. And then Brent, take a look at oil, which has been the main release valve for people's sentiment towards the war. Back at $115. The highs we got to during the last month or so was $119. So we're getting very close to that again, up 2%, despite the fact that a significant amount of oil, about 60%, has managed to be rerouted. Some of that oil that was meant to go through the Strait of Hormuz is now being bypassing the Strait of Hormuz via landlines. And we've also had the IEA extra production, the stockpile as well coming to the market. But even with all of that, we are seeing Brent creep back up higher again as the market really accounts for perhaps long-term destruction and disruption in that space. Aluminium also in focus today. Take a look at where we're trading, up 3.9%. The reason being 2 aluminium smelters were hit over the course of the weekend. They were targeted. Emirates Global Aluminium over here in the UAE alongside Alba in Bahrain, where damage is still being assessed, but ultimately just another manifestation of how commodities markets are getting hit, and the physical market is also getting disrupted as well. So keeping a close eye on aluminium prices this morning, up almost 4%. And then 10-year yields. This is quite interesting. This is an interesting development because so far we've been talking about the inflationary impact that higher oil prices are going to have. For the first time today, what you're seeing is the inverse impact. So even though we're seeing an inflation shock, actually, U.S. Treasuries have started to rally, maybe because we've reached interesting levels, or it could be the fact that they're accounting for a growth shock. So actually, 10-year Treasuries are down 4 basis points today. And then finally, switching over, because this war has been going on for a month, we took a look back at some of the worst performing assets throughout the course of the month. Asian indices had a rough ride, but so did European markets. Take a look at European stocks, down 10% for the month. This is the worst month since the pandemic, since 2020. So the caption here is it's endured a horror month, but essentially it has been a very challenging month for European equities. But let's talk about other markets, Asian markets now. Avril Hong is in Singapore for us. Avril, walk us through the handover this morning.
Yeah, as you highlighted earlier, it was a negative handover as we're seeing Asia stocks getting battered. The Nikkei, the Kospi at one point, both of these indices slumped as much as 5%, even though you're pairing some of those losses at the moment. I think it's this idea that investors are perhaps pricing for a longer drawn-out conflict with these fresh escalations. And we are also not just watching the weakness that you're seeing in stocks, but also in currencies, the Japanese yen, the Indian rupee. When it comes to the yen, what was interesting was earlier today getting comments from Japan's FX chief talking about bold action if necessary. And why this is significant is because he hasn't said something like this since July 2024. And typically these signals are the final warning for speculators before the Japanese authorities actually pull the trigger on actual intervention. So that's something that we're watching. And of course, this follows on from the Japanese yen breaching 160 against the greenback late last week. So it's managing to keep things in check for a bit at the moment. As you said, Jumana, is really the selling that we're seeing in Asia stocks as well for now.
Avril, thank you so much. Avril Hong in Singapore. Let's get back to our top story. There's no end to the Iran war in sight as it enters into its fifth week, with strikes continuing across the Middle East. President Trump says that Tehran has given in to most of the U.S.'s demands, even as it remains unclear whether either side is negotiating.
Sir, could you foresee a deal in Iran this upcoming week?
I do see a deal in Iran, yeah.
Mr. President.
Could be soon.
They offered a 15-point plan to Iran. Did they ever come back?
Yeah, they came back on the 15-point plan. They gave us most of the points.
That's as the Iran-backed Houthi militant group joined the conflict over the weekend, raising concerns over shipping via the Red Sea. And an additional 3,500 additional U.S. troops have also arrived in the Middle East. For more, we're joined in Dubai by Stuart Livingston-Wallace, our executive editor for MENA and Russia. Well, there are plenty of developments to go through from the weekend, Stuart, but maybe let's just start with the arrival of this first Marine Expeditionary Unit. We know that they got to the region on Friday, 3,500 troops. Do we understand what the objective is of sending these troops to the region?
No, not really. I mean, there's been plenty of speculation, and the options seem to be the following. And again, I should, underline this is speculation. No one has said anything officially. But potentially taking over Karg Island, that is certainly something that the US president has spoken about quite recently. However, there are questions there of how they would actually get to Karg Island, because you would presume, given that they're an amphibious assault group, they would have to go via Hormuz, and we all know the problems in Hormuz. Secondly, potentially taking over islands around the mouth of Hormuz, or taking over perhaps some Iranian territory on the edge of Hormuz. And then to add to that, there's obviously been reports of additional troops being moved in, we presume over the next couple of weeks. But the short answer is we don't quite know what they're going to be deployed or how they're going to be deployed. And it's entirely feasible that it's sort of really a way of upping the ante.
And another front opened up on Saturday with Houthis entering into the war, targeting Israel through a series of attacks. How should we read this latest expansion in the war?
I mean, it is quite surprising that it's taken this long. I mean, it's been sort of the better part of a month, and I think there was an anticipation that they would come in around the same sort of time as Hezbollah came in. You remember they started firing rockets several weeks ago. However, this one seems to be quite cautious, and by that I mean that, to our knowledge, they've only targeted Israel so far. They haven't gone after any of the other neighbors, nor have they yet started attacking shipping in the Red Sea, although obviously, they did more or less shut down the Red Sea for a couple of years, so it's a real possibility. And we have seen those advisories coming out of maritime organizations with regard to ship owners saying just be very, very cautious. So it remains to be seen just how much they might expand this. That's something we'll just watch over the next few weeks.
And Stuart, the big news on Friday was the fact that President Trump had pushed back the deadline for Iran to make a deal to April the 6th, which is a week Monday. And yet, if you look at the intensity of operations over the weekend, things appear to once more have been intensified, just in terms of the infrastructure in Iran that has been hit, and in return, the infrastructure in Gulf states also that Iran has targeted.
Yeah, absolutely. And you saw that, as you said, there was the steel plants that they went after in Iran, and then the retaliatory attacks went after the aluminium plants on this side of the Gulf. So it's in a similar sort of pattern to what we've seen before. And I think particularly with regard to the April 6th deadline, that was explicitly tied to attacking Iran's power plants, or at least some of the power plants, which, as we know, Iran has threatened to do exactly the same in return. So to some extent, we haven't seen that level of escalation yet. But again, it's one more dent in global trade. It's one more dent in the commodity markets. And again, that's going to have an inflationary impact that we presume will go on for at least many months.
Stuart, thank you so much. Stuart Livingston-Wallace, our executive editor for MENA and Russia in Dubai. Well, speaking about markets, joining us now is Lombard Odier, Chief Economist and Switzerland CIO, Samy Chaar. Samy, good to have you with us. Well, It's a big risk-off day in the markets today. The handover from Asian equities negative. Brent also back up to $115. Markets seem to be accounting for the fact that there doesn't appear to be an end in sight to this war and have to start reflecting the real possibility of a very protracted conflict here. Do you think that this is the right read? Do you think markets are overreacting or still being complacent about some of the risks ahead?
There is a symmetry here. It seems that the possibility of further escalation is as big as the possibility of a de-escalation and negotiation from here. So the situation is completely fluid. And as an asset manager, when you don't really know, you simply come back to base, right? The idea is to eliminate from the portfolios the active risks, get as close as you can to your strategic asset allocation, and basically wait for when you get further clarity on the situation. But very clearly, it does seem that it can escalate as much as it can de-escalate. So active bets here are probably too much of a risk considering the situation.
I note in your report that you have structured a couple of scenarios for oil. One of them is with oil remaining at around these levels, $115, and you say that would trigger an inflationary slowdown in the global economy. But the second, a more extreme case, is when oil tops $150, and that would cause a lot more extensive damage to growth. Do you think the world can live with $115 oil?
Yes, I actually think it can, right? We've been there in the past, so it's important for us to be able to assess what happens with different sets of prices, whether the oil price and or some other inputs. And to be fair, we've played that movie before, so there is a degree of certainty of what can happen when the oil price is around 115 rather than when it is around 150. And again, potentially if it de-escalates, we also have to keep in mind a scenario where the oil price is below 100 over the rest of the year. And when you drive through these scenarios, frankly, Jumana, it takes a lot to break the current expansion that we're benefiting from, right? To get into a more recessionary feel, it would take the oil price higher than here. Of course, the current oil price, if it stays there for many months, means an inflationary slowdown. So there will be a cost, there will be damage from the current level of the oil price. But very clearly, not so long ago, we've been there and it hasn't killed the global economy. So it would take actually much more to go into something more severe, more damaging, and into an outright contraction. 115 might be a severe slowdown, an inflationary slowdown, not necessarily a recession.
Okay, interesting. Samy, have you actually changed any positions in your core portfolio on back of the war?
What we've done again, Jumana, is to eliminate a couple of active risks that we had. We did not have so many, to be fair, getting into the conflict. But what's important, considering the situation, is obviously countries and regions like Europe, Asia, that are energy importers, obviously are bound to have more sensitivity to the situation. So that is something where we've gone closer to benchmark. And for the rest, really, we feel that we have the portfolio to weather that kind of storm, wait for greater clarity. And again, the key here is certainly to remain very close to long-term strategic asset allocations.
Yeah. Let me ask you about the price action in fixed income today. I don't know if you heard me at the top of the show, but I thought it was interesting that for the first time, you're actually seeing fixed income react to the growth shock as opposed to the inflation shock. Do you expect that paradigm to continue, or is this just a one-off today?
No, I think you're absolutely correct. There's certainly a limit from where yields can go from here. Again, there are vast differences to the situation today when it comes to the inflationary backdrop than the one we had in 2022, let's say, when central banks had to rush into hiking rates at a very, very rapid pace. If you remember at the time, we also had an energy shock from the Ukraine and Russia war, but very differently, we also had an overheating labor market. We had a lot of wind in the sails with the stimulus post-COVID. We had excess savings, and we had central banks at zero lower bound on negative interest rate, which is not the case today. As you know, central banks are neutral or slightly conservative. So it does mean that, again, the reaction function of central banks will be different, and the tension and the pressure from long end yields probably more limited than what we've experienced a couple of years back.
Samy, always good to have you on. Thank you so much. Lombard Odier, Chief Economist and Switzerland CIO, Samy Chaar. Well, up next, more on the escalating conflict in the Middle East as President Trump says Tehran has now offered further concessions. We speak to William Roebuck, Executive Vice President at the Arab Gulf States Institute and former U.S. Ambassador to Bahrain. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. President Trump says Iran has given the U.S. most of the 15 demands it issued to Tehran to end the war. This comes even as it still remains unclear whether either side is negotiating. Earlier, Trump told the Financial Times he wants to seize Iran's oil resources, which would require a risky military operation involving the invasion and occupation of Karg Island. Joining us now is William Roebuck, Executive Vice President at the Arab Gulf States Institute and a former U.S. Ambassador to Bahrain. Really good to have you with us on the show. Let's just start with the pushback of the deadline President Trump gave to Iran to come to the table for a deal. He's now pushed it back to April the 6th. What is the likelihood, do you think, that we get a negotiated end to this war in the next week?
I don't see that happening, to be honest. I mean, the situation is very fluid. One side or the other could make a dramatic concession, but it seems more likely that we're on some sort of escalation track for the U.S. The way it's sending in all these forces, Marines, 82nd Airborne, it looks like escalation is in the cards rather than some sort of negotiation at this point.
But at the same time, the number of troops that is being sent, let's say around 10,000 in total, would suggest that if there is a military objective, then it would be something akin to a targeted raid, as opposed to, of course, a full land combat operation at this point. So do you think that they're being deployed for deterrence purposes or for actual military objectives?
It's a good question. I had the view previously that he was doing things primarily for signaling purposes, but it seems like he actually uses these forces once they're in place. So I think, although, as I say, it's a fluid situation, my sense is that the likelihood is that these forces will be used for some sort of assault in, it looks like, in the Persian Gulf. There are a number of targets they could go after to try to create some sort of leverage and some sort of decisive messaging impact.
Do you believe that the U.S.'s war objectives have shifted and that now perhaps top of mind is actually the reopening of the Strait of Hormuz before anything else?
Absolutely. They have to get the strait. They put themselves in a bind, really, but they have to get the strait reopened in order to achieve the other things they want to do, which is to get to a negotiated settlement, to get to an off-ramp. With the strait closed, Iran has significant leverage, and they have the ability to say when, essentially, these other things can happen. So I think absolutely he has to find a way to get the strait reopened. The problem is it's not easy to do militarily. Iran closed it without really using large amounts of military force, just with threats and some force, some attacks, limited attacks on ships, and that's been enough to close it. Getting it open is going to be difficult.
What do you think would bring Iran to the negotiating table? I mean, again, we're just going on rhetoric here and what they're saying. They appear to be quite defined. We don't know what's going on behind the scenes. But ultimately, at what point do you think Iran will say, okay, let's sit down and try to come to a negotiated end to this?
I think Iran, that regime, I mean, their primary focus is survival. So anything they get involved in, they're going to want to see that there's an exit for them to survive in a legitimate way to continue to exercise power in Iran. So they're willing to play some of their cards. They're willing to negotiate with the United States. But what I've read, at least in the demands that the Trump administration has put forward, I don't think the Iranian regime sees anything in that would permit them to exit from this situation into a situation they would find a credible one for the regime.
One of the often asked questions that has come up in the last couple of weeks is whether the Gulf states may have an appetite to enter into the war militarily. And I understand they don't speak as one sort of monolithic structure, and certain countries like the UAE and the Kingdom of Saudi Arabia have been a lot more outspoken. Mm-hmm. But what do you think the line is for them to just take it one step further?
The Gulf states are, they've been very exposed throughout this process. They have, just in terms of their energy infrastructure, they have literally trillions of dollars lying out exposed in terms of huge oil processing mega plants like Ras Laffan and Qatar, Aramco and Saudi Arabia, and all of the other things, petrochemical refineries, tankers, pipelines that go with it. And they have sovereign wealth funds. They have a non-oil economy now that is highly significant, and they're building it for their future. So in addition to trying to protect their populations, they're focused on protecting those incredibly valuable assets. So they feel exposed, and I think they've tried to position themselves so that they are facing the least amount of risk to their populations and to those assets that I just described. And it's creating a lot of stress, I think, on the leaderships, but they've been strategic, and I think they will continue to make very strategic decisions in a way that will minimize the risk that their people and that their infrastructure and assets for the future face. That's what's going to shape their decisions. How they will respond specifically to getting involved in the military campaign will be shaped by those calculations.
Yeah. William Roebuck, Executive Vice President at Arab Gulf States Institute and former U.S. Ambassador to Bahrain, thank you so much. Well, still ahead, Ukraine looks to the Middle East for fuel and defense partnerships. We'll bring you the latest on his trip around the region. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks and futures drop and oil jumps as fears of a prolonged conflict in the Middle East take hold. Global bonds advance with investors worried that higher crude prices will weigh on economic growth. President Trump says Iran has given in to most of the U.S.'s demands from its 15-point plan, but it remains unclear whether each side is even negotiating. The Yemen-based Houthis joined the war, striking Israel and saying they'll continue fighting until attacks on Iran and its proxy militant group cease. That's as thousands more U.S. troops arrive in the region. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Note the time change of our show now for the next 6 months. We are going to be an 8 to 9 a.m. show. So just leaving that bit of housekeeping there. As to markets, the handover pretty negative this morning. It is a cautious, risk-off tone as the market digests the developments over the weekend. The fact that more ground troops are being deployed to the region, no letting up and intensification of the strikes and counter-strikes on Iran versus Gulf Arab states. And this is the picture. So Asia Pacific, the handover down 1.8%. This is for the broad index, and this is after coming off a very negative month indeed for most of these indices anyway. And Brent, take a look at that. We're back at $115, up 2.5%. More attacks on key infrastructure in the region. We're going to talk about that in just a moment. But the reaction on oil has been once again an uplift at $115. At the height of this war, we got to $119. So we're not that far away from those highs that were reached a couple of weeks ago. Aluminium also in focus today, up 3.7%. And here we're talking about two targeted attacks on two key aluminium smelters in the region, one in Bahrain and Elba facilities. They're still assessing the damage there, and the other at Emirates Global Aluminium over here in the UAE, which seems to have impacted the production there too. So on the back of that, you are seeing also a push higher in aluminium prices this morning. And then 10-year yields, this is actually quite interesting, are down 4 basis points today. And many are saying that fixed income investors are beginning to account for the growth shock outweighing the inflation shock that's coming from commodities. So 4 basis points lower in the front end, it's even more pronounced. So interesting development there as the market sort of prices in a protracted conflict and what that could mean for economic indicators around the world. And then switching over, I mentioned Asian markets. Let me just show you that for European markets, it was a March to forget. European stocks down 10%. This is the worst month we've seen since COVID. So you have to go all the way back to 2020. And of course, Europe are a key importer of energy from the region. So the market's accounting for that. All right, but today, though, let's check in on how markets in Asia are faring. Avril is in our Singapore office for us. Avril.
Yeah, Jumana, we're seeing Asia stocks down today, as you highlighted. Leading the region's losses are the Japanese, South Korean markets, dragged by the tech-related stocks, the chip makers. But it's also worth highlighting what we're seeing in Indian assets. Stocks there have been seeing outflows exacerbated this month, and the idea of how vulnerable the country is to the Middle East conflict because of its huge imports of energy. But today, the focus on Indian assets is really on the Indian rupee, because after the close on Friday, which is following on from the rupee already breaching the 94 level against the greenback, the RBI came through with fresh rules to curb speculative one-way bets on the market, and that's had a reaction already. We're seeing the rupee at one point climbing about 1.5% against the greenback, although it's paired some of the gains now. The reaction function is also on the Indian lenders. This gauge of them, the Nifty Bank gauge, is at its lowest level, or roughly around its lowest level since at least April last year. So you can see how the energy concerns are filtering through into Asia markets. Jumana.
Avril, thank you so much. Avril Hong in Singapore. Well, as he spoke about, oil is gaining as Iran-backed Houthi militants in Yemen enter the war and more U.S. troops deploy to the region, raising fresh fears the widening conflict in the Middle East will disrupt global energy markets. It comes as U.S. President Donald Trump keeps insisting he's ready to make a deal, saying Tehran has offered further concessions on allowing oil through the Strait of Hormuz.
They've agreed to send 8 boats 2 days ago, and then they added another 2, so it was 10 boats. And now today they gave us as a tribute, I don't know, I can't define it exactly, but they gave us, I think out of a sign of respect, 20 boats of oil, big boats of oil.
Joining us now is Bloomberg's Middle East energy reporter, Anthony DePaola. Anthony, talk us through the price action in oil markets this morning. Why are we 2.5% higher, do you think?
Good morning, Jumana. Yeah, that was interesting this morning to see that we're up to 115, as you mentioned there, when we were kind of bouncing around 100 and a little bit higher last week after some of that positivity of some of these deadlines getting extended by Donald Trump. Where we're at now indicates that people are nervous about the strikes continuing. As we said, about the continued closure of the Strait of Hormuz and those troops coming into the region. So this kind of idea that potentially there's more in store. And what really the issue is that continued closure of Hormuz. Until the Strait of Hormuz gets opened and there is that free flow of crude and refined products, metals, other chemical feedstocks going through the Strait of Hormuz, markets will not get back to where they were before. So that's indicative that clip that you just played of President Trump talking about Iran giving us boats, giving us oil to come through. When, remember, just a month ago, this was a free waterway where tankers were flowing freely and without danger. So that's the big change that we're facing right now. And the prospect of that continuing is really what's impacting us right now, Jumana.
Yeah, I saw a post that our colleague Javier Blas put up over the weekend suggesting that about 60% of the crude flows through Strait of Hormuz have actually managed to be rerouted or compensated for by this extra stockpile release from the IEA. I mean, that is a considerable number. To what extent do you think that is actually cushioning some of the blow that we could see on oil prices? I mean, even with all of that, we're at $115.
Yeah, for sure the market is taking some comfort of the ability that there are alternative routes. There is the Saudi East-West pipeline, which is the biggest alternative route that runs from the big oil fields in the east of Saudi Arabia to their port in Yanbu on the Red Sea, and they're able to export from there. We reported over the weekend that pipeline is up to its full capacity of about 7 million barrels a day right now. About 5 of that is being exported because the other 2 million is going to local refineries, which are also sending diesel and jet fuel into markets like Europe. So that's also needed fuel. So most of that is getting exported either as crude or as product. So that's a benefit. In the UAE, we've also reported on a pipeline to Fujairah, which has come under repeated attacks, the port there specifically, and that's interrupted flows. But those flows are still ramping up to pretty high levels. So that's for sure a benefit and a cushion to prices. And let's not forget that Iran is sending some of its own oil out of the Strait of Hormuz. I think that's a little bit more of a head scratcher for markets, because where does that oil, that Iranian oil, go when it becomes unsanctioned, as the Treasury has decided? Are Western refiners, Western-linked refiners like those in Japan, Korea, going to buy that oil? Are there refineries ready to take it, or is that still going to continue going into mainly Chinese refineries? So we're not back really to where we are. There's still a major deficit. Also, even as that crude goes out, again, I mentioned all those chemical feedstocks, LPG, LNG, all those things still trapped in the Gulf, and so that's really a strain on the global oil petrochemicals complex.
Anthony, thank you so much. Bloomberg's Anthony DePaula. Now, developers in the UAE have held calls with investors to allay concerns over a potential liquidity crunch. The calls are made as the developers' bonds slip into distressed territory, with debt issued by the companies rated below investment grade by major ratings firms. Joining us now is Katralnada BinGhatti, CEO and Managing Director of BinGhatti Holding. Katralnada, really good to have you with us on the show. I know there's been a lot of talk about the impact this war could have on property prices, so we appreciate you coming on the show to talk about it. The first question I want to ask you is, how has buyers' behavior changed? Are they holding off decisions? Are they postponing decisions? What are you seeing?
Well, Jumana, thank you for having me. One thing we need to remember is that we are only 4 weeks into this conflict. So let's talk about what we've seen during those 4 weeks. From an overall market view, we've seen just shy of 15,200 transactions in the market. If we zoom into BinGhatti's portfolio, and of course, we are prioritizing the projects that we have slated for completion this year. And if we look at those projects are on average about 90% sold. And in terms of price behavior or client behavior or market behavior, let's remember that behavior is always driven by liquidity, and there still is liquidity in the market. And even the inventory in terms of listings, a lot of the inventory that we are seeing in terms of listings is actually relistings. In fact, over about 60 to 65% of it is actually relistings. So in terms of, market behavior, the behavior still seems relatively stable.
And what are some of the scenarios that you're accounting for in terms of decline in collections, in terms of the average a drop in selling prices. Can you walk us through some of the baseline scenarios that you're looking at here?
Absolutely. So this is really important. In light of the circumstances, the first thing that we did actually as a company is a stress testing model. And the most important outcome of that stress testing model is liquidity. And that's, in reference to the calls that you were referring to earlier, that is the main central theme of these calls is stress testing liquidity. And one of the things that we do when we build these models is test the sensitivity of our liquidity relative to price and price corrections. And we've actually modeled price corrections that go as far as 20 to 30% in terms of price drops, which is a very aggressive assumption, but the company remains relatively healthy from a liquidity standpoint. The other thing is when we talk about worst case scenarios, one of the things that is out of our control is how long the conflict carries on for. And the most important factor in terms of modeling the sensitivity in terms of how long the conflict goes for is an important factor that a lot of people are not talking about is the split between residents versus non-residents. And the reason this is important relative to how long the conflict goes on for is even if the demand from non-residents softens, the actual lion's share of our demand is from UAE residents. So that's an important factor in terms of demand dynamics. There's a larger weightage assigned to actual UAE residents as opposed to non-residents.
Okay, that's an interesting perspective. I was going to ask you about whether you've seen a shift in nationalities. What about in terms of the divergence in demand between sort of mid-level and luxury? Are you seeing anything notable there?
So this is an important point as well, actually, and I'm glad you were asking about this, Jumana, because one thing to remember is when we're talking about the nationality of buyers or the divergence between luxury versus non-luxury products, it's important to contextualize the portfolio of BinGhatti because traditionally there's been a lot of focus and I think we've attracted a lot of attention for our branded uber luxury projects, but not to forget that over 2/3 of our portfolio is made up of mainstream and mid-luxury projects. And those types of projects are much more resilient and they're a lot less speculative. So that's why we haven't actually seen a large shift in terms of nationality or even a large shift in terms of sales because of that skew towards mainstream and mid-luxury product.
But just on that point, how much of is that underpinned by population growth? And I've been in the region for the last 2 years, and I feel like every conversation we've had about property, we've talked about the influx of new people coming into the region. How much of the outlook is underpinned by population in the UAE continuing to grow?
Yeah, absolutely. And in fact, pre-conflict, we were talking about that with our fixed income investors as well. We were talking about the 2040 Urban Master Plan, the D33 agenda. And I think one of the things that the UAE and the Dubai government has been very smart about is actually creating domestic demand, even pre-conflict. In fact, as early as 2024, when the CFO and I would go on these roadshows and speak to fixed income investors, we were actually, even as early as 2024, talking about latent demand and demand coming from within the UAE as opposed to just this influx of population or inward migration that's coming into the UAE. So we saw a lot of long-term tenants or people who have traditionally been tenants for so many years actually become homeowners. And this was actually encouraged by for example, the first-time home buyers program, which was launched by the DET in partnership with the Dubai Land Department. So I think a significant portion of that demand is actually underpinned domestically.
Katralnada, real pleasure to talk to you today. Thank you so much for taking the time out of, I'm sure, a very busy time for you. Katralnada BinGhatti, CEO and Managing Director of BinGhatti Holding. Well, for more of these stories looking into the intersection of wealth and power in the region, sign up for our Middle East Money newsletter on Bloomberg.com. And coming up, Angola taps global markets and moves to buy back debt. We'll find out what this means for its finances next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Angola is moving to reshape its debt profile after a successful return to international markets. The country raised $2.5 billion in a Eurobond sale, with plans to use $500 million of the proceeds to buy back existing debt due in 2028. The finance minister, Vera Davis de Souza, says the government will continue to explore all financing options as it looks to improve its debt profile.
We will keep our eyes open to all the opportunities that can come up, not only from the international markets, but also from multilateral partners that can support us to address our development agenda.
Our Chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. So what does this tell us about investor confidence in Angola right now?
Well, Jumana, the fact that the country was able to successfully raise this Eurobond was a positive signal, and that's what we heard from the minister in her communication. And she still feels like the case is building for optimism for investors. You take a look at the fundamentals there. She says there is fiscal discipline. The country is working towards economic diversification, and in doing so, they're over time attracting more and more investment. So it seems like the fundamentals are in place. She reiterated that a few times during our discussion, but still there's quite a lot to be questioning at this point in time from an investor perspective. Of course, Angola is Africa's third largest oil producer, so we've seen quite a bit of windfall in terms of what they've been receiving since the war started, but still Angola imports most of its fuel, considering they aren't able to refine enough for the demand that is needed in the country. Not just that, there's also poverty is still quite a big issue. And she talked about the fact that they still need to work on a lot of the services that the population needs. She talked about health and also sanitation and things like that. So really the core issues that investors are still trying to watch quite clearly. And then not only that, the big uncertainty is really what comes next year in 2027. It is a big election year. We've heard signals from the president that he does plan to follow through on stepping down after his term is finished. So that could bring with it some uncertainty that investors are unlikely to be able to at least plan for at this point in time, especially if you consider a lot of the factors that are in place right now. So I would say that from an investor perspective, it is seeming like cautious optimism, but still quite a lot of improvement still needed for the minister, the finance minister, and also the government to communicate in order to get to, I think, a bullish reception from the investment community.
Jen, thank you so much. Jennifer Zabazaja, our Chief Africa correspondent in Johannesburg. Well, Ukraine is expanding its engagement in the Middle East as President Volodymyr Zelensky visits the Gulf. Zelensky has signed agreements with Saudi Arabia and Qatar and is holding talks with the UAE, offering Ukraine's air defense and anti-drone expertise. For more, we're now joined by Bloomberg's Greg Sullivan. So Zelensky doing a tour around these Gulf states, but also announcing some agreements. How significant are these new defense agreements?
Well, it really underscores the position that Ukraine is in. Its traditional ally, the U.S., is obviously very distracted by the war in Iran. And largely even before the war, aid from the United States had largely evaporated. Then you have the European Union. There's a 90 billion euro loan that's being held up by Hungary. So there's real concern in Kiev over where they'll find supplies and support to continue the defense against the Russian invasion. Here he is in the Middle East, and he's basically making the pitch that we have experience repelling drones, and including drones, Iranian drones. And so he's trying to leverage that to get military ordnance and also, as we heard from him, fuel supplies. We know that markets are really in turmoil right now, and there's concern over where fuel can come from. He said he signed a year-long contract for diesel. So he's really trying to leverage what Ukraine has to make sure that they can still find military ordnance.
We've spoken about the fact that that Russia is emerging as one of the big economic winners of this war, not least with the waiving of the sanctions on Russian oil. But interesting also developments on the battlefield over there, with Ukraine continuing to target some key Russian energy exporting facilities. What impact is that going to have on Russia's ability to finance the war, as we speak about them benefiting from, one, the temporary removal of sanctions, and two, higher oil prices?
Right. Well, this really does come as a bit of a blow to Russia. It is curtailing their ability to really export and capitalize on this rise in oil prices. Russia started the year in a bit of a precarious situation with a widening budget deficit, a slowing economy, and here they are suddenly with a rise in oil prices that they would like to capitalize on, even if just to help rebuild reserves and shrink that deficit. But Ukrainian attacks on oil exporting facilities is really curbing that capacity. For Russia to benefit from this spike in oil prices, really it's going to come down to two things. How long do oil prices remain elevated, and how successful is Ukraine at curtailing their ability to actually export fuel to the market?
Greg, thank you so much. Bloomberg's Greg Sullivan with the latest on Zelensky's trip around the Gulf. Okay, we are starting the week off on a negative foot for equities. So let me just run you through some of the key equity bourses before we switch over and talk about, obviously, the main indicator that everyone's watching is oil. But equities, handover from Asia, pretty negative this morning. And at one point, we had S&P futures leaning towards about 0.5% weaker. In the last half hour or so, we have paired some of those losses. So now trending flat. But take a look at European markets. Futures there look like they're going to be opening up down yet again, significantly down 0.8%. And this is after, as you saw earlier on the show, a loss of more than 10% for the month of March. That is the steepest decline European markets have seen since COVID. But let's switch over and take a look at how the oil complex is faring. Again, some more upward pressure on Brent this morning. We are back at $115, 2.5% higher today. WTI in the U.S. also up 101 at 101, so up 1.8% higher. There's still a wedge between the two, obviously, to account for the origin of the crude oil. But essentially, you are seeing another upswing in the energy complex this morning. And as we were speaking about with our energy reporter, as long as the Strait of Hormuz remains effectively shut or controlled by Iran, you're going to continue to see this upward pressure, despite successful rerouting attempts that we've also seen. And then finally, just to wind things up, I want to take a quick look at U.S. Treasuries. Interesting phenomenon happening today, which is that Treasuries have actually been rallying despite the push upwards in oil. So 2-year yields are down 3.5 basis points, 10-year down 3.6 basis points. And here, what you're seeing is the market beginning to account for the fact that there's going to be a growth impact from these higher inflationary prices, if higher prices to come from the commodities shock, higher inflation, and ultimately there's going to be some sort of tightening of demand. And we've seen many Asian economies move towards that direction, imposing some controls on when consumers can use their energy. So this is an interesting phenomenon that hasn't happened yet throughout the course of this war. It is still day 31 of this war, and really no signs of things de-escalating or a negotiated off-ramp at any point in the next few days. That is it for Horizons Middle East and Africa. I'm Joanna Bersachi in Dubai. And just on a housekeeping note, our show will be from 8 a.m. over the next 6 months, so stay tuned for that. This is Bloomberg.